It didn't start with a rally, it started with a balance sheet nobody liked. A struggling retail company, declining sales, closing stores, hedge funds betting year after year that the business would shrink until it didn't matter anymore. By late 2020, that bet had become crowded. Short interest ballooned, borrow rates crept higher. Shares were harder to locate, but the trade still looked obvious to most professionals, fading a company that appeared trapped in the past. On the surface, it was routine. Underneath, it was fragile. A small group of retail traders noticed something strange. Public data suggested that more shares were being shorted than were easily available to trade. It wasn't hidden. It was just ignored. Deep dive posts appeared online, breaking down float numbers, lending dynamics, and what would happen if too many short sellers tried to exit at once. The posts weren't polished. They were obsessive. Screenshots of spreadsheets, hand-drawn diagrams, long threads that few people finished reading. But markets don't move when everyone agrees. They move when a minority presses where structure is weak. Early buying nudged the stock upward, not dramatically, just enough to sting anyone leaning too hard on the downside. Some short sellers trimmed, others held. Funds with conviction often don't move first. They wait for noise to pass. That waiting would matter. The early buyers weren't loud. They weren't posting targets, and they weren't streaming. Most of them didn't even talk about it publicly. They were watching borrow rates tick higher. They were reading quarterly filings. They were tracking how many shares were actually available to lend. They noticed that the pool kept shrinking. That matters in a heavily shorted stock because every borrowed share is eventually owed back. And when too many people owe the same thing, timing becomes lethal. Some hedge funds began quietly trimming exposure. Others doubled down. Short sellers tend to be stubborn by nature. They build theses over months, sometimes years. They don't abandon them easily, especially not because of message boards. That conviction would collide with something they hadn't fully priced in. Crowds. Then the options market woke up. Call buying accelerated, short-dated contracts, far out of the money, cheap lottery tickets with asymmetric payoff. When traders buy calls in size, the dealers who sell them hedge by buying shares. That hedging pushes price higher. Higher prices make more calls profitable, more calls get bought, more shares get hedged. It's not a narrative, it's plumbing. And once it starts, it feeds itself. The stock broke through technical levels most desks were watching. Newsrooms noticed. So did brokerage apps. So did social media timelines that normally argued about crypto or index futures. Screenshots spread. Account balances flashed. People who hadn't traded equities in months opened apps again. Short sellers felt it immediately. Losses mounted as price climbed. Margin requirements rose. Risk managers called. Positions that had once looked patient began to feel heavy. Covering a short means buying shares. Buying shares adds pressure. Pressure forces other shorts to reconsider. That's how squeezes cascade, not through panic but through arithmetic. The arithmetic became impossible to ignore. Borrow fees surged. New shorts struggled to locate shares at all. Prime brokers started calling clients. Not to threaten, to ask questions. Are you comfortable with this size? How liquid is your exit plan? Those conversations change behavior. Slowly at first, then all at once. Covering pressure doesn't announce itself. It builds in silence, then shows up as urgency. Over several days, the move accelerated. And here's what truly separated this episode from every other short squeeze before it. It wasn't only the math, it was visibility. In past squeezes, traders worked in isolation. Funds didn't livestream positions. Retail traders didn't post broker statements to millions of strangers. Price moved, rumors followed, but conviction stayed private. This time, conviction was public. and constant. Online forums transformed into command centers. Threads refreshed every few seconds. Screenshots of brokerage apps flooded timelines. Green numbers, exploding percentages. Positions held overnight. Positions rolled forward. Some traders posted proof of ownership. Others posted that they hadn't sold a single share. The phrase "still holding" became a rallying cry, not a strategy, as identity. Live streamers kept cameras on charts for hours. Comment sections scrolled too fast to read. People asked, "Are you still in? Did you sell? Who's buying this dip?" Every answer mattered, because uncertainty spreads faster than confidence. But confidence, when repeated loudly, spreads even faster. What formed wasn't coordination in the legal sense. No central leader, no formal plan. It was something newer. Mass synchronization through visibility. People didn't need to talk to each other privately, they just needed to watch. If enough strangers were holding, then maybe holding was safe. If others were buying, then maybe the risk wasn't as crazy as it felt. Markets had never experienced that kind of feedback loop before. Not at this scale, not in real time. Some traders admitted later that they weren't reading filings anymore. They were reading timelines. They weren't watching fundamentals. They were watching sentiment. How fast comments moved. How many viewers a live stream had. How many screenshots appeared in an hour. Those metrics became proxies for conviction. Professional desks noticed this shift too. Not because they cared about memes, because flow was behaving differently. Retail participation didn't fade after spikes. It intensified. Every dip attracted more buyers. Not because the dip was cheap, because the dip was public. Millions of people watching the same 5-minute candle changes behavior. Liquidity providers adjust. Risk desks widen models. Short sellers rethink timelines. The crowd was no longer reacting to price. Price was reacting to the crowd. The internet also changed the psychology of selling. Normally exits are quiet. You flatten, you move on. No one applauds. But during the squeeze, selling became visible. People announced exits. Others criticized them. Some were accused of betrayal. Some deleted posts after price surged again. That social pressure made holding harder and easier at the same time. Harder because risk was rising. Easier because you weren't alone. That combination is dangerous. It blunts fear. People who might normally take profit hesitated. Because the story wasn't over. Because the comment said it wasn't over. Because someone else just posted a screenshot twice as big. That is how bubbles extend. Not through greed alone, through comparison. Every night, traders went to sleep with positions they had never held before. Waking up to 5-figure swings, 6-figure swings. For some, the numbers were surreal. Screenshots looked fake. Balances that belonged to hedge funds last month now lived on phones. That disbelief fed resolve. If something feels unreal, it feels like it might keep going. Media amplified it further. Headlines about retail versus Wall Street. Panels debating whether markets were broken. Stories about small traders paying off debt. Stories about hedge funds bleeding. Those narratives pulled in a second generation of participants. People who had never traded options. People who had never shorted anything. People who opened accounts just to touch the event. That's how it became the squeeze of that era. Not because the structure was unique. Short interest had been high before. Gamma loops had existed before. Funds had blown up before. What hadn't existed was a crowd watching itself in real time. Cheering, posting, reinforcing, turning risk into spectacle. That visibility extended the move, deepened it, made it harder for shorts to wait, made it harder for longs to leave. And when both sides lose patience at the same time, price stops behaving politely. Markets didn't just reprice a stock. They repriced how information spreads. They repriced what crowd behavior means when millions of participants can see each other's positions instantly. After that week, no short interest statistic looked the same again. No viral chart looked harmless. Every squeeze carried a memory. That memory still lives in markets today, in options chains lighting up overnight, in social sentiment dashboards, in funds scanning message boards the same way they scan earnings reports, in traders asking one question the moment something starts to move. Is this turning into one of those? Halts paused trading repeatedly. Each reopening brought more volatility. Up 10%, down 8, up 20. Volume reached levels normally reserved for the largest companies on Earth. The stock became unavoidable. Cable news panels debated it. Politicians tweeted about it. Day traders live-streamed screens while thousands watched candles form in real time. For a moment, markets felt less like institutions and more like amphitheaters. Inside brokerage firms, it felt very different. Risk desks ran overnight scenarios. What happens if volatility doubles again? What happens if settlement obligations spike? What happens if counterparties fail? Clearinghouses demanded updated stress models. Collateral requirements recalculated in real time. These weren't political decisions, they were mathematical ones. Every trade has to settle. Every buyer must pay. Every seller must deliver. When price becomes unstable, that plumbing becomes the entire story. Behind the spectacle, plumbing strained. Clearinghouses demanded more collateral from brokers as volatility exploded. That's standard. They exist to ensure trades settle even if firms fail. When required deposits ballooned overnight, some brokerages restricted buying in certain names. Not selling, buying. The decision ignited outrage. Retail traders felt locked out of a trade that had suddenly defined the era. Conspiracy theories flourished, but the mechanism was boring. Risk, margin, settlement. Systems designed for calm suddenly dealing with a storm. Hedge funds were not a single enemy. Some were crushed. Others were long. Some traded volatility. Some exited early. Markets did what they always do in stress: redistributed pain unevenly. Some retail traders cashed out at this stage. Early entries. Six-figure accounts suddenly staring at 7. People withdrawing funds for the first time in their trading lives. Screenshots turning into bank transfers. Those moments didn't go viral. People who actually lock profits usually disappear. They stop posting. They close apps. They breathe. Others hesitated because the story was still growing, and stories are addictive. At the peak, price detached from fundamentals almost entirely. That wasn't an insult, it was a description. Valuation stopped driving decisions. Positioning did. Liquidity did. Who needed to act next did. For many retail traders, unrealized gains became life-changing on screens. For others, entries came late, after headlines, after friends bragged, after the story had already matured. Those were the most dangerous moments in any market. Some traders quit jobs that week. Others told families they were done worrying about money. Some bought cars, some paid off loans, some planned houses. They weren't reckless. They were responding to numbers that had never existed on their screens before. That is intoxicating. That feeling rewires judgment, anchors expectations, turns pullbacks into opportunities, turns exits into betrayals of future versions of yourself. Eventually, gravity returned. Not all at once. Volatility stayed violent, but momentum slowed. Early buyers sold, short pressure eased. Options flows normalized. Without forced buying, price lost its engine. Late arrivals suffered the most. People who discovered the ticker through headlines, through short clips, through coworkers, through relatives texting screenshots. They bought calls with days left until expiration. Premiums so high they required miracles just to break even. When volatility collapsed, their contracts decayed faster than price, directionally correct, structurally ruined. Others used margin. When price dropped, brokers sold for them. Not emotionally and automatically. Liquidations don't wait for hope. Weeks later, the stock traded far below its highs. Online forums changed tone. From victory chants to confusion, from screenshots to postmortems. Threads titled, "Should I have sold?" I was up six figures. I held. People argued about villains, but markets don't need villains, they only need imbalance. Hearings were broadcast, executives testified. Lawmakers asked about clearing cycles, margin frameworks, short disclosure, payment for order flow. The structure of trading, invisible to most participants, became front-page news. Market participants quietly rewrote models. Funds updated squeeze risk metrics. Prime brokers adjusted leverage limits. Retail platforms changed policies. The machine absorbed the shock. That is what markets do after trauma. They adapt. Here's the deeper tonic. The meme stock didn't explode because people were reckless. It exploded because structure allowed pressure to stack. High short interest, thin float, options leverage, social coordination, media amplification, settlement mechanics, all aligned at once. That alignment is rare. That is why it was historic. Retail didn't overthrow Wall Street. Wall Street didn't crush retail. Participants collided inside a system that was not designed for millions of traders pressing the same instrument simultaneously. Some walked away transformed. Others walked away broken. Most walked away changed. Markets remember events like that. So do people. And the next time something begins moving quietly, they pay attention. Real events, real consequences, real lessons. This is Market Tonic.